Good afternoon and welcome to Watch Your Six. I'm Jason Edwards, your host, and it's nice to have you back. Hope you've had a good week and maybe some days off to relax and recharge your brain. So we're going to start off with a topic that has become very popular to many of our listeners, and the specific topic is crypto. And one in particular, our clients asked us about this. They said we didn't know enough of this on the podcast. So we thought, you know what, this would be a good opportunity to maybe dive into crypto a little bit, talk a little bit about some of the pros and cons. It is such a relevant item today. It's become incredibly popular. Everyone talks about crypto, but what everyone does not talk about are the downsides. So first we'll start with the upsides and the things that are obvious to you that if you're trying to invest in crypto and you're looking at crypto as an opportunity to maybe diversify. One of the things is the high potential gains. I mean, crypto has had some, and there's no lie, entities like Bitcoin and other cryptocurrencies have had some massive returns. And those massive returns have been incredible because what's happening is people are comparing them with traditional investments and they're saying, wow, this is incredible. It's almost too good to be true. So the return or the rate of return on crypto is probably one of the key core components that drives people and in some cases make them feel like they might be missing out. Another thing that we always talk about on this show is diversification. Remember, asset classes, and the more asset classes you have in your investments, the better you are positioned to withstand a market correction. So cryptocurrency is just like another asset class. It's an asset class like a stock or a bond or real estate. So if you add those portfolios to your repertoire, your investments are going to have a little bit more diversity. So that's something to think about. Liquidity. Liquidity is another key component of cryptocurrency. Unlike the stock exchange or unlike your bank, there are no hours. It's 24/7. So you don't need a bank, you don't need a broker. You can invest, you can monitor, you can mitigate and work with the crypto environment 24/7. So that's incredible. I wouldn't recommend that because you're probably exhausted, but that's something else. Transparency and security is another key component or pro of cryptocurrency. Blockchain's technology has become so impressive now that you can see everything in real time. It's verifiable. It's very difficult in some cases to hack, but as we're going to learn the cons, it is hackable. So the transparency of technology, the ability to see it on your phone, track your activity, those are great components that people look at. Temporary transparency and security is one component. Accessibility is another component of Bitcoin. With Bitcoin, anyone who has an internet access can invest. So the days are gone. We have to call your broker and get someone on the phone and schedule an appointment. With Bitcoin, you've got a phone, an app, and next thing you know, you're investing. You're buying, you're selling. So those are great components. Innovation and growth potential is something that really makes people feel excited about crypto because as we see the ecosystem changing, the applications and some of the resources that cryptocurrency are using, for example, smart contracts, etc., those innovations are speeding up the process of crypto. And that's something that many people don't realize. The rate that crypto starts to expand has the propensity to make people feel really excited, but also have a thing what we call FOMO, fear of missing out. Now, hedge against inflation is one of the other key components that crypto traders look at, and some call it a crypto gold. They say it's a great way to keep pace with inflation and the cost of living. And they look at it as like a gold investment. It's just as solid. I'll put my money in there and I'll have that opportunity. So those are all what we call the fuzzies, right? Those are all the real nice and warm and fuzzy components of crypto. If you're looking into crypto, you've heard all of those. You see the advertisements online all the time to buy into this, get your crypto wallet set up, etc. But here are some of the cons. And this is the stuff that sort of cryptocurrency traders don't like to talk about. Let me ask you a question. If I was to tell you to give me your money and I'm going to put your money in this investment and this investment could lose 50% in a day, how excited would you be? Well, you probably wouldn't be too excited. But that's the downside with crypto. Crypto has extreme volatility. You have portfolio positions that can drop 20 to 50% in days. So if you're putting, your life savings, your net worth, your retirement account in place, then you're dealing with what we would call Russian roulette. So that's one thing that's very scary. The second thing is regulatory uncertainty. Governments are still trying to figure out how to regulate crypto. And you think about it, each government's going to be different. So that is a huge huge black hole because we don't know how those governments are going to deploy their regulations as it relates to crypto. So government uncertainty is a real thing that could impact the value of crypto. And imagine you've built your crypto up to $1 million, $2 million, or $100,000 or $50,000, and a government comes to say we're going to regulate it this way, and all of a sudden now your values drop 50%. That would not be a welcome wake-up call. Security risk is a big thing with crypto. While the exchanges are somewhat secure, exchanges and wallets can be hacked. And here's the downside. If your wallet gets hacked or your cryptocurrencies get stolen, who do you go to? There's no government. There's no law enforcement entity. There's no regulatory oversight. You have nobody to be able to discuss this with and say, what's my ramifications? So now, again, you're talking about a loss of your personal savings, of your assets, and something that we traditionally are very concerned about. Another concern is a lack of consumer protection. So in this country, the United States, for example, we have FDIC insured. So these banking institutions have some type of coverage that is provided through them and the government. So your cash is somewhat protected. With cryptocurrency, you don't have any of that. You don't have any access to protection. There's no oversight. There's no protection against insurance fraud. And unfortunately, fraud does become fairly relevant now in the crypto world because there's no oversight, there's no norm, there's no regulation. We just saw recently last year a gentleman get put in prison with a very large crypto entity, right? And he was embezzling money for millions and millions and millions of dollars. So those kind of things are challenging. Another thing that people have to be careful of is the complexity and the learning curve of crypto. Remember, crypto is not what you think about it is. And again, you take these little sound bites online, but understanding how your crypto wallet works, understanding how your exchange works, understanding how your private keys work, understanding how the investment access and contributing as well as the liquidity work, those can be overwhelming. So what happens traditionally is someone goes on a social media site, hears something about crypto, jumps into it, tries to open and navigate it, but they're doing it from this, flying by the seat of their pants. They're not really understanding the nuances. They're not understanding the ramifications. They're not understanding the accessibility. So it can be very daunting. And remember, for example, you lose your passkey, you're done. If your crypto wallet's locked up, there's nobody to call, say, hey, can you help me? I forgot it. There's all kinds of variances that can really impact you. One of the other thing is market manipulation, and that is becoming more and more relevant. We would call it prone to what they call pump and dump. So you have these smaller cryptocurrencies coming on the market. They know people are monitoring them. What they do is they flood them with their own money, and now that thing starts to spike. It's called market manipulation. And what you do is you see it, you jump in, go, great, I'm going to jump in and wait a couple months. They're not waiting months. They're waiting hours. They take the money out, make their money, and now your portfolio drops to nothing. Remember, that is a very, very common scenario that is happening more and more because crypto is not driven and its valuations are not driven by an entity creating gross domestic product or sales or client inventory. It's specifically driven by the amount of currency coming into that particular entity, and it goes up. So you could think about it almost like a multi-level marketing. More people buy in, and as more people buy in, then that person that bought in 5-10 years ago starts to go higher up the peg, and his valuation goes up, and then more people buy in, and the one below keeps going up. So it's a chain. But that's one of the dynamics with crypto that makes it somewhat scary. And those kind of things are one of the challenges. And the last but not least, remember, we always talk about investing and looking at investing with goals. So your short term, your moderate goal, and your long-term goal. Most investors will invest with some type of goal in mind, and it's a long-term goal. Well, crypto, you can't bet on that. There are going to be currencies that are going to lose their relevance. And when they lose their relevance, what happens? Well, it's gone. So you've got to now stay in play and think about which cryptocurrency will stand the test of time, how long will it stand the test of time, how relevant will it be, how long will it be relevant, and how much assets do I want there. So in summation, what I would say to you, and again, we don't recommend specific investments because we want you to talk to your financial planning team. You're welcome to DM us and work with our firm. But what I want to do is tell you, use crypto as a small portion of your portfolio. I know people on social media go, oh, you're crazy. I made millions. Yeah, but it's not what you made, it's what you take. So I would say to use crypto right now in its current environment as a asset class, just like your stocks are an asset class, your bonds are an asset class, your real estate's an asset class. And I would say if you're not very, if you're not very familiar with the crypto environment, you want to probably start with money that you're comfortable losing. That's a great place to start. So start with a smaller nuance of capital. Get your crypto wallet set up, get your passkeys working, and then see how it goes. If you're making money in your existing portfolio investment strategies, don't let the FOMO I alluded to or greed drive you to do something unwise, because the graveyards are full in the investment world of people who got greedy and did something unwise. You've had market correction after market correction, and unfortunately the individuals that got greedy or didn't use practical investment advice, we can see that they lost over time dramatically, and that's not something that we want you exposed to. So in summation, we talked about what cryptocurrency is. We talked a little bit about, the pros and the cons. We hope that gave you some information to think about and to marinate on. There is no silver bullet when it comes to investing. Sound investments with a sound strategy is a phenomenal way to consistently make wealth, and wealth is relevant. If you're trying to make wealth because you have a small amount of money, we talked about it before, use some of the stable cores of our investment we've talked about in previous shows, but crypto could be an asset class that you would use. I just wouldn't get heavy into it right now. So hopefully that answers some of the questions, and our clients that had questions about cryptos, hope they enjoyed that portion of the podcast. We're going to talk a little bit today about what's going on in the cash market. Now, as you've seen, the 4% yields in money markets have started to dissipate. So for those individuals that are very conservative investors, they start to become nervous because they don't want to be in the market. They don't want to have the exposure. They're trying to figure out. But if you leave your assets in cash, and with the Fed consistently cutting rates, you're going to find yourself in a very, very awkward situation. And what do we mean? Well, unfortunately, when it comes to market volatility, a lot of clients have the propensity to say, I'm really nervous. I'm just going to leave it in cash. I can't lose. Well, you can. We've talked about this in previous shows. Cost of living. What did $100 buy 10 years ago versus today? If that $100 was not keeping up with the cost of living, that $100 is basically useless compared to 10 years ago. And you see how much milk costs, gas, etc. So your money can't just sit in a bank account with no growth. So inflationary protection is critical. And if you're risk averse, there are other things you can think about. Now, you don't want to look at short dated treasury bonds right now because those are also impacted by Fed rates. So when you have scenarios where you're like, hey, I want to put it in a money market, I want to put in a short dated treasury book, well, those dynamics are setting you up for failure as well, because again, it's about rate of return. If inflation is floating at 4 to 5% and my bank account is making 1 to 2%, what is my net growth? Well, it's a loss. Now I'll go one step further, and here's the thing we talked about in previous shows. If you're putting your money in a CD or you're putting it in a high yield savings, even that little 1 or 2% is now a taxable event. So at the end of the year, here you are, you've made no money, the portfolio hasn't grown, and now you owe taxes on that money. So that wouldn't be what I would consider a smart way to look at it. One of the other things I would tell you to then look at is what we call short-term commercial paper. That's a really good tool. Another one is a high-quality corporate bonds. And why is that? Well, because those have a very stable environment. They have a higher yield, thus the term high quality. And you're typically higher up the level when it comes to culpability or being paid back if there was some type of scenario. So if you take a high quality corporate bond and let's just say, God forbid, the company started to sort of sell off and dissolve, you're going to be in a higher level on the ladder to sort of get some of your money back, unlike an equity owner or stock owner. Those could be things that you want to look at. Those are some of the other areas. And then also looking at short maturity active exchange. There are short maturity active exchange traded portfolios, ETFs, that can hopefully get you around 3 or 4% if you're looking at that kind of environment. Because again, you may be risk averse. Now, don't make the mistake though of letting your emotion dictate your environment. We've talked about this before. If you continue to try to look at rate of return versus historical facts versus the functionality of the market, you might blindside yourself. Remember, I've shared this stat before. From 1994 to 2004, the average yield in the stock market was over 7%. The average investor only did 3%. Why? Well, emotion. They let emotion override logic. Every market correction we've had, and we've shown this on the show before, every market correction has a finite point to it. Eventually it ends, and the bull or the uptick from there is dramatic. So those are some things you could look at. Another thing you might want to look at, and we touched about it before, are junk bonds. Now, they're a little more volatile, but you're talking about a higher payout. You're talking about a payout that in some cases can be 4, 5, 6%. Those are opportunities where you might want to look if you're, again, risk averse and you're looking at it to try to mitigate but keep pace with inflation. And that's critical. The individuals that would traditionally be more worried about this were people that are sort of in retirement or getting, past retirement now. So they're in their 60s and 70s and they don't really want to do anything with their money other than keep pace with inflation. But again, as we've talked about it before, you don't know what you don't know until you talk to a professional. So get your investment team together, get them brought together and discussing that, and look at, what are the pros and cons? Can you introduce maybe a little equity in the portfolio so that you've got some growth? Because if you're living off your investments, you'd like to get a raise every year, wouldn't you? And you'd like to have a little bump up on income. And if you get too conservative, that will not happen. So hope you enjoyed that part of the podcast. As always, we really enjoy talking about these investments. We recommend that you email us or DM us. If you DM us on social media, we'll get those questions on air and we will try to answer many of those questions and give you some insight. We will be having a smart book coming up fairly shortly that we're going to be offering to our listeners. So be on the lookout for that link. And we're going to try to answer some questions for you on Watch Your Six. Be right back. Hey, welcome back to Watch Your Six. As I mentioned, I'm Jason Edwards. This is the fun part where we get to listen to you, the viewers. And we've got some really good DMs from Grady. So he's going to ask us and we're going to see if we can answer them for you. Grady, what do you have?
Hey, Jason. The first one is, I saw your ebook post. What is going to be in there?
So an ebook, obviously, is going to be electronic publication, but we're going to try to put in some short but tactical information that you can use individually. It's impossible to put a book together. We've got a book that's being written right now and eventually be published, but we're going to try to put something that's going to be short to do things to look at in your investments, things to look at from your liability, things to look at when it comes to protecting your assets, things to think about when it comes to trying to build wealth, things about when it comes to savings. So we're going to try to give you a sort of an abbreviated, short, what we want to call your cheat notes, your cliff notes, remember college, and that'll hopefully give you something that you can sort of use as a tutorial. Again, it's just designed to be information. It won't be personalized. We always recommend you talk to an individual advisor or planner to get your information, but hopefully you'll enjoy it and find it useful. But good question.
Sounds like Jason's financial literacy boot camp, huh?
Maybe. We'll see. It will be.
Next one, love your post about savings account versus investment. Now that I have 6 to 8 month buffer, should I create a completely separate bank account? Should I continue to do all my business with my home bank, or should I shop around?
So that's a great question. So remember now, you're setting up stages. So your 6 to 8 months is your immediate account. That's your rainy day fund. That is, I lost my job, car broke down, leaky roof. So that's your short-term duration. Now, what you're going to is what we call your intermediate duration. What a lot of people make mistakes of is they have a savings account and they have a retirement account. There's nothing in between. Well, when you want to go on vacation, what do you end up doing then? Your credit card, or you end up taking money out of the savings, which I don't want you to do. So I want you to set up what we call a non-qualified account. It can be set up your bank, be set up any kind of brokerage company. You can go online and what's into these online trading organizations or with your firm. And that non-qualified brokerage account will start to morph into a bank account with investments. So that's where you're going to start putting your liquid assets and building. Why? Well, first of all, it's liquid. So if you overextend yourself, you can pull the money back in. But the second component is we're going to start to interject or add investments to there. Now imagine 4 or 5 years of savings, but you've added 15 or 20% of interest. Well, now the interest can pay for vacation, right? The interest can pay for a new car. The interest can pay. That's what you're talking about, making your money work. If you just save and pull it out, that's basically just playing a shell game. In this case, now we've created what we call a pre-retirement account. It is an account that's designed for everything from now until you decide to retire. So that's what I'd recommend. If you want to use your bank, that's fine. I personally like to recommend you go with investment planners because the diversity of funds, there's over 4,000 different mutual funds. If you open an account with a bank, in some cases, they have a very focused viewpoint. So they may have a tendency to use only funds that they like. I would recommend getting an independent viewpoint on it, someone who's not proprietary, because you're going to have a potential for greater growth. But that was a great question. What else you got, Grady?
Next one. I heard you say there are some recession-proof investments in the past that go against the regular flow of the market. Could you dive into that a little?
So we use the term recession-proof, but they're not really recession-proof. A better discussion would be alternatives. There are investments that are considered alternatives by definition, and what that means is they don't track with the market. So there's a ratio, there's an indicator called a beta, for example, that will tell you how your portfolio investment will mimic the stock market. Well, these act in direct contrast to the stock market, and they are very, very, very effective tools. Now, I wouldn't recommend putting a large portion of your portfolio, but they could be private equity funds, they could be private real estate positions, they could be ETFs. I mean, there's a whole litany of alternative investment out there. But if you've got an investment company, ask them, hey, what kind of alternatives, that's the term we use, alts. What kind of alts do I have available to add to my portfolio? It's a great way to insulate yourself against market corrections because, as I mentioned, they don't track with the market. They have its own investment environment. So when the market corrects and drops 30 points, your alt may only drop 3. Depends on what portfolio you're in. But those are a great insulator, I think is a better term, against investment decisions and against investment allocations, but more specifically to give you a little peace of mind. But they're very unique. They're very specific. So do your homework on the pros and cons, how liquid they are, how long they've been around, who's managing them. Those kind of components make a difference.
Bitcoin versus altcoin and sports crypto.
So we had a big part in this show about crypto. We try to avoid promoting or endorsing anything because of the cons I've shared with you. What I would say to you, though, is do your due diligence. How long has the currency been around? What is the volume of the currency? What's the historical volatility look like? And what's the easy accessibility? Do you have to go through a particular broker? Can you use a crypto wallet? Can you have your own wallet? How can it be set up? How easy is the passkey to set up? Remember, those are things that you want to know. It's really hard to do your due diligence on a crypto position because you don't have much data. You don't know where they're based. You don't have government. You don't have any kind of revenue stream. There's nothing for you to track there. So while Bitcoin is the big boy in the block, there are a lot of good currencies that are coming up. But remember, be careful of the smaller currencies. We talked earlier about the pump and dump. That's something that can manipulate it. So if you want more information, though, DM us and we'll try to give you some insight on it. Anyway, thank you for tuning into the show. We're excited that you were here. We look forward to seeing you next week on Watch Your Six. I'm your host, Jason Edwards. Have a great week.